welcome everybody. My name is Joe Mass, and I again thank you for joining us for our Q1 2026 market review. We have some really cool new additions for you this quarter. First of all, as you know, we're always trying to not tell you how we build the clock, but to show you what time it is. And so I think you're going to see some new formats in our slides this quarter. Again, we're trying to make these friendly and for all audiences. Most of the time when we show lots of charts and graphs, we're not deep enough for some people and we're too deep for some other people. So we're trying to get it just right. So hopefully you'll really enjoy this format today. The other thing that I want to do is I want to welcome Tim Nyland, a good friend of mine. Tim and I have worked together off and on our projects for probably 20 years. And Tim has now joined Synergy as our co-chief investment officer. And I'm very excited for you to get to hear from him today. And Tim's going to be sharing and jumping in as we go through some slides. So Tim, welcome. And again, I'm very excited for the audience to get to know you. A lot of you have probably known Tim over his careers, but we're very, very lucky to have him here at Synergy. One of my fears when we are giving a presentation like this is we're going to give you so much information. I don't want you to panic and feel like you have to rush out and do something. Most of you aren't going to have to take any action after this, webinar today. In fact, we'll summarize this at the end. Tim will talk about what you should be doing and what we should be doing. So just sit back and enjoy the show. Listen and learn, but don't worry. There's nothing you're really going to have to rush out and do. We do these every quarter. And again, remember, guys, we're not day traders. We believe that what we're trying to do is provide better diversified portfolios. Remember, based on reasonableness, based on reasonable returns with reasonable risk over reasonable time for reasonable people. And so although we like to continually communicate to you through our weekly writings and our weekly videos and our monthly videos, our monthly writing and our quarterly writing and our annual writing, our annual videos, we probably are over communicating. So one of my fears, again, is in trying to do a good job in communicating to the audience that we're not leaving you with the impression that you must rush off and do something. Okay, so just sit back and enjoy the show, and we'll have some fun. So, the slide that we're looking at here is, the first half of this year has been very interesting, right? It's been an up and down quarter, and we're going to kind of walk you through kind of what happened in the past, and then we're going to walk you through what we're going to think is going to happen this year. So on the next slide, here's a quick roadmap of today's discussions. We've kind of organized these into sections, and so you can see that here, starting with more of a high-level overview of the quarter, and then we're going to drill down into the equity markets and the global returns and the asset classes and the sectors. All of that detail that we usually give you, plus that broader market cycle, okay? We're also going to cover some fixed income, the economic indicators. As many of you know, we have proprietary models for both the market cycle and economic cycle. And so we're going to talk about those. And then later on the portfolio, Tim's going to walk you through our outlook, our positioning for Q2 and beyond. Okay, so the next slide, on slide 3, there was really 3 major themes that were defined in Q1 of 2026. So as most of you know, that U.S. and Israel military campaign in Iran triggered a near blockage of that Strait of Hormuz, so the war. And that's really a big choke point, right? Roughly 20% of the global crude goes through the strait. We've put a lot of other pieces out between the start of the war and today on crude and oil, so please be looking for those if you haven't read those. But Brent crude did surge above $117 per barrel, and that was really what was reigniting the inflation fears and rattling the global markets through March. So that I think most of you are aware of that. That's in the headlines. And then second, tech experienced a meaningful correction, right? And so those elevated valuations we've been talking about finally met those rising rates and the discount rates. And so capital kind of rotated out of growth names, right? We saw that pullback. And then third, inflation surged. And maybe even more than inflation surging, the fear of inflation has surged even faster. And so driven primarily by that energy shock. And so we think that this is going to force the Fed into a kind of a wait and see posture, right? And so these three forces combined, make Q1 one of the more challenging quarters in several years. So lots to talk about. So on the next slide, what we're going to do here is this chart is just showing the monthly returns of the major U.S. equity indexes during Q1. So January, right, rolled in was a bright spot. It looked great. The markets posted moderate gains, as you can see in those blue bars, coming off a really solid 2025. But February, March erased all of that and then some. And so the major U.S. indexes posted their worst quarterly start since 2022. The sell-off was broad, even in the metals, right? We've been talking about metals a lot last year, who had done very well, but we've seen metals really not be a safe haven. They've been, off and on again. So it was a broad-based sell-off. And it wasn't really isolated to any one corner of the market. It was broad. So the call out cards here on the right break down the individual index performances. You can see damage was widespread across large cap, mid cap, small cap, and those international benchmarks. Okay, so let's go to the next slide. What we're going to do here is we always like to kind of zoom in on the S&P 500 specifically. And the reason we focus on the S&P 500 is that this is one of the most popular broad-based U.S. benchmarks that most people pay attention to. And so we usually focus in on that for you. So this chart traces the price action through Q1. You can see that in January, there's that January rally we talked about, and then the February rollover, and then the sharp March decline driven by the Iran escalation and those the shocks in oil prices. So the stat boxes below, you can see highlighted the key metrics for each month. And this context is important because it shows how quickly sentiment shifted. 1 month of gains was wiped out by 2 months of selling pressure. So keep this in mind as we look at the global and sector level breakdowns, because we're gonna drive or drill down into those next layers. Okay, so on the next slide, what we're seeing is that these are the global and regional market returns, and so the slide compares returns across the major regions of the equity markets for Q1. And what's notable is the divergence. While U.S. markets struggled, international markets showed a mixed picture, depending on their exposure to energy shocks and the geopolitical risks. So the chart on the left ranks the global regional market returns, and the cards on the right break down each region with its returning context. So understanding these regional dynamics is critical for diversification, and is one of the reasons why we don't just solely focus on the U.S., right? We have an international portfolio. Most all of the portfolios we manage can use some type of international exposure, and so that is why we include the global markets in the work that we do here at Synergy. Okay, on the next slide, we're going to look at the asset class returns, and this is one of my favorite slides because it gives you the full asset class picture in one view. The chart ranks Q1 returns across equities, fixed income, commodities, alternative investments. The table on the right provides the specific return numbers. As you'd expect, energy and commodity linked assets were the clear standout performers given the oil price surge, right, because of the war. And while growth-oriented equities and longer duration bonds bore the brunt of the sell-off. So this is exactly why diversification across asset class matters, right? That is the whole point of having more than just one A in a basket. And that's why our model emphasizes it. So no single asset class wins every quarter, and this quarter provided that in dramatic fashion. On the next slide, we're going to look at the sectors, right? So these are the sectors of the S&P 500. And this is where the story really gets interesting. The chart and the table for Q1 sector returns, and the dispersion is significant. You can see energy was the runaway leader. Again, no surprise there, benefiting directly from the oil price surges. And on the other hand, technology and communication services were among the hardest hit, as rising rates compress those valuations. Remember, when rates go up, that hurts valuations on those growth stocks. So healthcare, utilities held up relatively well as defensive plays. So again, we saw some of that rotation into the defensive sectors. This kind of sector dispersion creates opportunities for active managers in tactical allocation. So this is an opportunity. We're always looking for how we can reposition things And I think what's interesting here, you can see that the S&P 500 on the blue and the box on the right, it was down 4.6, which is kind of right in the middle of the pack, right? You saw energy at the top, about 12, a little bit over 12%, and then consumer discretion is down 11.2. And so the S&P was, if you just held the S&P, was right in the middle. And so again, this is where in some of our models, we try to rotate, and those models are trying to find the winners at the top and avoid those losers at the bottom. So that's why active asset rotation is one of the strategies that we like to deploy amongst our synergy portfolios. Okay, on the next slide, this is our market cycle. As you know, we have what do we have here? 30, 40, 50 plus factors that we look at weekly. And, we do this work every week at Synergy to assess the overall health of the economy and expansion. And we weight the forces pushing, markets forward, whether they have headwinds or tailwinds, right? Pulling them back, the ebbs and flows. And we score a bull and bear factor. And just because we do this every week doesn't mean that we need to trade it every week. The key takeaway, despite the volatility and the negative headlines, this quarter or scorecard still indicates an expansion in the economic conditions. And so that's still a bull case, right? And that's why we look at both the market cycle, the economic cycle, and as you've heard me talk about in the past, that emotional cycle. So on the bull side, you can see 6 factors scoring positively. Corporate earnings grew at 13% year over year. So companies are still generating strong profits. And that's, as you've heard us talk in the past, that's my favorite indicator is the profits of the companies. That's why stock prices. AI capital spending exceeded $650 billion. So that really represented a secular growth driver that transcended the cycle. Net profit margins remained healthy at 13.2%, meaning businesses are managing cost effectively, even as the inputs prices have risen. Employment is holding near, a tight labor market continues to support consumer spending. GDP growth is running around 2%. Remember, we can grow at 2% for a long time. You're never going to probably overheat an economy if you're just growing at 2%. But slowing significantly in Q4 and the revisions that might come. So it still remains an issue. It's still in expansionary territory. So we can look at investment grade credit spreads remain tight. The bond market is not predicting a crisis yet. As you know, we always like to look at the bonds as the first indicator of what might be happening to the equity market. So that cross market analysis really helps us get a big picture. On the bear side, we have 6 factors that bear close watching, right? Everyone knows that CPI is reaccelerated. We talked about that in the first or last quarter market update that we expected inflation to come up a little bit, maybe roughly 3%. Mainly driven by, again, the energy shock. But that oil prices is probably the single biggest factor there. So inflation is something we're going to watch. But inflation squeezes that consumer's budgets, right? So if the budget is constrained, that means people spend less money, and that's not good. Remember, maybe 70-80% of GDP comes from consumer spending, and so that's why watching those factors on how the consumer is squeezed might give us a telltale on what their spending habits are going to be, and then that would, of course, relate to or move into profits. Recession probabilities climbed. We like to look at several different models, and in here we can see, there's probably anywhere between 30 and 49% chance of a recession, depending on whose data that you want to look at. So that changes every day. But the Fed probably has 0 to 1 rate cuts priced in for 2026, which is a significant shift from earlier expectations. And again, as we've talked about in the past, with a new Fed chairman, that the market may test them. And so we still have to watch the Fed closely. They're kind of in a rock and a hard spot right now. Trying to, a lot of you probably heard of stagflation. You've heard of inflation and deflation. So a lot of people are worried about inflation with low growth. So we'll have to see what the Fed does here. Okay, so on the next slide, you're going to see that we are talking about what's driving the markets. And so you guys know that we love to look at this. There's 5 specific factors that usually affect the market cycle, and the underlying data behind the scorecard, that is the scorecards that we just reviewed. So what we're going to look at here is inflation, right? If inflation's up, that's typically negative for stocks. If it's down, it's positive. So right now we have kind of a bearish outlook, as we've been discussing on inflation. CPI is roughly 3%. The PCE is roughly 2.7. Energy prices are reaccelerating well above the Fed's target. When it comes to interest rates, again, interest rates up are bad. Interest rates are coming down are good. Right now we have that as a bear. They're elevated. The 10-year at 4.3, 0 to 1 Fed cuts is what's priced in for 26. When we go to corporate earnings, this is again a bright spot. Earnings have been up 13%. I think that's about the 6th consecutive double-digit quarter. So very, very resilient, very strong right there. The Fed has been, if they're restrictive, that's bad for the markets typically. If they're accommodative, that's good for the markets. So right now, it's probably bear to neutral. They're restrictive. The Fed's on hold. Again, at most, maybe one rate cut. Inflation is going to limit that easing. So we'll let you know if this data changes. This is just what we're seeing right now, okay? And then, of course, that 5th factor, the geopolitical events, if the markets, if there's a lot of volatility in the geopolitical markets, the markets usually don't like that. And if they're calm, they would prefer that to continue their march upward. So definitely having some volatility with the U.S.-Iran conflict in the Strait of Hormuz and the oil surging above 117. And we'll just have to continue to watch that. We put out some data earlier in the year that shows that, normally the market probably recovers, from this pretty quickly. And so we don't think this is, a new bear market, right? We're still pretty bullish on that. We're going to wait and see. So, but those are the 5 factors. Those are the 5 things that really drive the market and how we're scoring them as of the first quarter. Let's talk about fixed income a little bit. So this was a pivotal quarter for the bond market. The 10-year Treasury yield climbed as inflation expectations repriced higher, right? The Fed adopted a wait-and-see posture, so no rate cuts in the first quarter. And futures markets are now pricing 0 to 1, as I've said, for the rest of the year. May change, but that's what we have as of today. And that's a dramatic shift from the start of the year when 2 to 3 cuts were expected, right? We talked about that at the first market update. So for bond investors, rising rates mean falling prices, right, on existing holdings, particularly in those long duration portfolios. The short end of the curve held up better. So our position reflects this. We've been favoring short duration and floating rate instruments and short T-bills, which cushion the blow this quarter. And so the bond market, we still think the bond market and bond asset class is very important to have in your portfolio, and especially when we get into times that the world is volatile. So definitely do not forget about fixed income in your portfolio. What we have here is our economic dashboard, and so this just summarizes our monitor. And each card shows a different metric with a current reading and trend, and a few things stand out. So first, GDP is slowing, but still positive. We're not in a recession territory yet, right? Again, that's probably 30 to 50% probability of a recession over the next 12 months. Inflation is measured by the CPI and the PCE. Remember, the PCE is the Fed's favorite measure of inflation, has reaccelerated due to the energy shock. So again, pretty simple. If energy goes down, inflation is probably going to go down with it. And if oil continues to go up, inflation is going to continue to go up as well. So a lot of transparency in where that's coming from. The labor market remains resilient with unemployment holding steady, though initial claims have ticked up a little bit. Consumer confidence has taken a little bit of a hit. We talked about that at the beginning of the year. So that makes sense given rising gas prices and market volatility. The manufacturing PMI dipped below 50, signaling contraction. Remember, on those indexes, anything above 50 is kind of considered expansionary, and anything below 50 is contractionary. So the macroeconomic backdrop remains, broadly expansionary. P growth is intact. The earnings remain resilient. So we view current conditions as a correction with an ongoing bull cycle rather than a structural deterioration at this point in time, right? So we've been kind of talking about that. This might be one of the most kind of important slides of the deck, and it kind of really sums up our proprietary processes at Synergy Asset Management when we talk about our risk on, risk off regimes. And this is a regime. We also have some portfolios that are considered, they have a name of risk on, risk off, or RORO in the name. So this isn't talking about the RORO portfolio in particular. This is really the structural framework that we use to talk about risk on and risk off. So I apologize if there's any confusion between this use of the RORO or risk on and risk off versus the RORO model itself. But this model aggregates the indicators that we just reviewed into a single kind of actionable signal. And so as the end of Q1, our signal reads tactical hedge. And what that means is that we're in a defensive posture, but not fully risk off. In practical terms, we're reducing overall equity exposure, increasing our allocation to short, duration fixed income, like we talked about in cash and equivalents, and adding to energy positions to hedge geopolitical risk. And then therefore, we're maintaining core positions, but with tighter stop losses. So the four positioning items on the right detail exactly what we're doing. And with that, before I hand it over to Tim, you don't really need to worry about these weightings. These are proprietary models that we built, and some of the math and science behind it. So this is one of those clock building slides that we tried to make pretty. So the biggest takeaway there is right there in that green and orange headlines there is that the economic regime is still in an expansionary, but the market regime right now is bearish. And so that, therefore, when you're bullish and bearish at the same time, that is a tactical hedge. So does that mean you should go all the cash? No. Should you go all the stocks? No. This means that in this environment, you have to be cautious. Now, for a lot of you that have investment horizons of 5 and 10, 15 years, you're probably not going to really want to do anything, right? You're probably like, yeah, 4 or 5 years, I won't even remember this. But for those of you that have a shorter investment horizon, if you're measuring your investments over 3, 4, 5 months, then you need to have conversations with your primary advisor about making adjustments. And so remember last year during April 4th, when the tariffs really got hit by, we got hit by tariffs by China, we had the markets drop. Half of the investors that we work with wanted to go to cash, and half the investors that we worked with wanted to take all the cash and buy more equity. And so again, it's okay for you to have your own views. Again, people in this audience, some of you are going to want to raise more cash, and some of you are going to want to use these opportunities as buying opportunities. So again, remember that we have clients, and every one of you are uniquely different and are in good hands with the SAM model. Remember, our SAM model is a strategically aligned asset management model. It means that we are strategically aligned with your primary financial advisor, where they're acting as your chief wealth officer and we're acting as your chief investment officer. So together, we're making sure that you're well taken care of. Okay, so with that, I want to introduce Tim Nyland to you, and Tim's going to go over a market recap and our outlook. So Tim, thank you so much for being part of the team and for working so hard on this presentation and for all your knowledge and years of experience. And guys, Tim, we're going to let you go now, and everyone, Tim Nyland.
Thank you, Joe. Now we're going to transition into the recap and our forward-looking outlook section. So given everything that Joe just walked you through, let me discuss our outlook and how we're positioning the portfolios. On the left, you'll see what we're watching heading into Q2. Keep in mind that the Iran situation, as many of you can tell just by watching the news from a minute-by-minute basis, it remains fluid. And obviously, any de-escalation or escalation will move oil prices and markets significantly. So in addition to that, we're also closely monitoring Fed commentary. We're monitoring earnings season and obviously consumer spending data for signs of further deterioration or further affirmation that the bull market cycle remains intact. So Q1 earnings season is going to be instrumental in determining what the growth trajectory actually looks like for corporations. And Joe and I and Todd and the entire team, we're really looking forward to seeing what this perspective is from the boardroom perspective. We're going to be closely monitoring this corporate guidance for indications, I should say, of how the rise in oil prices is going to impact revenue growth and operating margins going forward. Joe mentioned briefly that this is one of his favorite fundamental factors, the earnings growth itself. And obviously that is because it is the lifeblood of equity valuations. On the right side is our synergy positioning posture. And as Joe mentioned, with the current risk on, risk off model and the tactical hedge stance, it's just important to remember that this is a macro market outlook, and this positioning is very high level. It's per portfolio and obviously where appropriate. So let me recap the quarter and highlight the key takeaways. On the left, the market recap, Q1 was defined by the Iran conflict, right? Spiking oil prices, a tech correction, and that inflation resurgence that Joe mentioned that really forced the Fed to the sidelines. U.S. equities started out January really, really strong, but then had their worst start to the year since 2022. And the bond market actually offered limited shelter as rates climbed. And this we've seen in previous drawdowns, specifically in 2022, the behavior was very similar. On the right, what does this mean for investors, right? First, diversification proved its value again. Portfolios with commodity exposure and the shorter duration bonds that Joe actually mentioned, they did hold up much better. Second, this environment continues to reward active management over passive index exposure. And third, the shift in Fed expectations, Joe mentioned again, from multiple rate cuts now to 0 to 1 rate cut. This fundamentally changes the investment landscape for the remainder of 2026 and is something that we continue to monitor with our analyst team, obviously on a daily basis. This is our market outlook for 2026, really laid out in 3 different scenarios. And I'm not going to go through each individual box. You can request a copy of this slide deck once we complete this presentation. So I'm going to just kind of go over each of these cases at a summary level. First, the bull case. Geopolitical tensions de-escalate, right? Oil prices normalize. The Fed is able to resume easing later in the year, and earnings growth reaccelerates. In that scenario, markets could recover strongly in the second half. The second case is the bear case there that you see in red. The possibility that the Iran conflict escalates further, right? WTI and Brent crude stay well above $100. Inflation becomes entrenched. Under this scenario, what we're looking at is that the Federal Reserve could be forced to delay rate cuts and potentially navigate a narrow path between stagflation and recession. And we've kind of seen some indications that stagflation is becoming a rising threat as of recently. So you can assure yourself that the Fed has got their eyes on this as well. Obviously, any sort of navigation of a narrow path between stagflation and recession, these are going to be both unfavorable environments for equities. So we're going to be definitely keeping an eye on that. The third box up there on the right, this is the SAM view. So this is our view, which is our base case. And this happens to fall in the middle, in between the bull case and the bear case. So we expect elevated volatility through at least mid-year, with a gradual de-escalation and the Fed remaining on hold, at least for the time being. Markets likely grind sideways with the rotation favoring value, energy, and defensives over excessive risk on growth. And what we're saying by value specifically over that excessive risk on growth is just more of that broadening of the market, which is actually a very healthy thing that we've been experiencing. So we're looking forward to that as our base case, and we are positioning accordingly for that. So many of you are probably sitting there wondering, so where do we go from here? What do we do from here? This is obviously the question that everyone's asking. And at the top is a quote that I like to put in this slide deck from Joe specifically. It captures our philosophy here at Synergy Asset Management. And it is in uncertain times, the worst thing you can do is really react emotionally, right? Panic selling locks in losses. Sitting in cash too long means missing any potential recovery. Obviously, the more times you do this, the more it compounds over time. And so the bottom portion of the slide, it really contains two columns. First, what clients should do, right? We should stay disciplined. We should stick to the financial plan. Avoid making big changes based on headlines. And second, what we do for you, right? We're actively monitoring every position, stress testing portfolios against multiple scenarios, implementing the tactical hedge positioning that Joe described, and communicating proactively. You don't need to watch CNBC every day, then monitor the daily grind of headline management. That's our job. We're just here to be the steady hand. Thank you all for your time today. If you'd like a copy of today's presentation, or you have questions about the Synergy Market Outlook, please send us an email at info@synergy-am.com. And lastly, if you have any questions about your specific portfolio, your asset allocation, or your financial plan, or anything else we've covered today, please don't hesitate to reach out. Thank you again, and we'll see you all next time.